Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend, Mr. Dan Bird. We're going to talk about the stock market. What a wild week. What a wild finish. Thursday was a nuts day. Let's talk to Dan about what is going on. How you doing, buddy?
Good. Thursday and Friday.
Yeah, Friday too, but Thursday.
I was wondering if Thursday was going to be a one-off, but it continued Friday.
So what do you see going on in the market?
It may continue next week, actually, as well. Yeah, let's talk a little bit about the market in general.
Sure.
And I'm going to share my screen. I'll show you my newsletter for anybody out there that wants to join it. It's something I do every weekend. I put it out yesterday. This is an excerpt from yesterday's newsletter. Usually have a couple of cartoons in there.
Yeah, breakpointtrading@gmail.com, just in case you are listening to this on the podcast. Breakpointtrading@gmail.com. You need to get on this. It is free. It is something I look at every weekend just to see what is going on, because again, for me, the stock market is just one of those data points that's like, is the consumer excited or greedy? And right now, I think a lot of people are nervous. So your newsletter is very, very helpful. So what do you got this week?
Yeah, so this is an excerpt from it. This is a few things here on the left. You know, everybody's wondering, is the selling over? We hit a support level at 4,100. It actually, which I was saying that we were going to hit and bounce there. My last week's newsletter, we actually hit 4,114 on Thursday morning.
And folks, you can actually go back to Dan's playlist and listen to last week where he pointed that out very clearly in our conversation. So nice work.
So could it continue higher? I mean, we've got a lot of headwinds. Ukraine, higher interest, inflation, Friday's jobs report next week.
Yeah. Do you want to play over under with me? I think there's expectations for 500,000 job creations. January was 443. You want to play over under on 500?
I have no idea.
Come on, flip a coin, guess.
I don't have a coin, but
all right. Well, I'm taking the under.
I don't know. I have no idea. I don't know what it's going to do. I will react, whatever it does.
There you go.
So one interesting point, and I always like to put some historical information in here about the market. The period from February 26th, which was yesterday, actually, to March 6th is the best period of the month for March.
Oh, wow.
So I think unless something drastic happens, like you were talking about before, the consumer in Russia, if they have a run on the banks, that could change things. But I actually think we're going to continue higher, and I'll show you where I think we're going.
Okay.
4450 is the reversion to the mean. So you've got to watch that area. It's important.
Okay.
So let's go over here, and I'll spend a little bit of time on this, but I'm not going to go through the whole thing. But this is interesting. This comes from Stock Charts, which I highly recommend. Stock Charts you can get for free. If you want some of the additional features that I use, then there's an annual charge. But a lot of what's on Stock Charts is no charge. This is a dynamic yield curve. This shows you the yield curve over about a 20-year period. So this is this one on the right is the S&P. And the S&P, like we've talked about before, this period from 2000, 2001, all the way to 2013 was a secular bear market. The market really didn't go anywhere. Yeah, it had a bull market inside of it, but it basically ended up flat for 13 years.
Yeah. So
what did the yield curve look like? I'm gonna animate this and watch this line. This is the yield curve up here. You're gonna watch it steepen and flatten. Okay. As we move through these periods. I'm only going to go up to the 2008 period. Okay. I'm not going to run it all the way to the end, because there were two inversions in that period. And you'll actually be able to see them here. So if you notice let me pause this for a second. If you notice down here in the lower right, it shows you the status of the yield curve. Okay. So right now it's normal. Got it. And the yield curve is a 3-month treasury, 2-year, 5-year, 7-year, 10-year, 20-year, up to a 30-year treasury. Sure. So what this means is, what is the rate for each of these treasury periods, and how do they compare with each other? So in a normal period, they should be steepening. The lower period should be lower interest rates, and the higher one should be higher interest rates. Of course. Right? That's a normal period. Agreed. So watch this down here. This will tell you whether it's flattening or it will tell you whether it's inverted. Okay. Little piece right down on the lower right. I'm going to stop it when it gets to inversion. Okay. So you can see here we're at 1999 right now. You can just watch the slope of the curve. You see it just went flat there for a second.
Yeah.
It's flat now, right?
Ooh,
Right there, it's inverted.
That's
all right. So now it's inverted. So now you can see the 2-year is higher than the 30-year.
wow. Did that say 2 years, 6%, over 6%? Oh my God, that's funny.
That's right. Yeah, that's another important point, because once we get towards we're not going to go all the way through here, but it's the yield curve is way down here on the bottom.
Yeah.
So another comparison to this.
That's
so
crazy.
you can see here the date is February 2000.
Mm-hmm.
And you'll notice the line right here is before the big drop off.
Ooh, yeah. Yield curve inversion, sign of a bear market.
2001.
Yeah.
Right. So
Yeah.
this yield curve inversions usually come 6 to 9 months before a recession. I'm gonna take a snapshot. It's gonna hold that line, and you'll see the rest of it compared to that line.
Okay.
So let me continue animating here and watch the slope. So it's still inverted, still inverted.
Wow.
Still inverted. Right there, it goes flat. So now we're in December 2000.
Okay.
And you can see the market is just starting to roll over right here.
Yeah.
Right. So it was inverted for this whole period.
Mm-hmm.
So this is an important thing to watch. So I'll animate it again. So now we're moving along. We're going through the 2000 crash. But the yield curve is normal now.
Oh yeah, for sure.
Because they're lowering rates.
Oh, look at that. Oh my God.
Right?
Look
at the rates going down here. The short-term rates are way down here now.
Yeah, look at that.
So as the market continues to crash, the Fed keeps lowering rates.
Mm-hmm.
Then it recovers right here. All right, so now it's recovering down here at the bottom.
That is a steep yield curve.
And look how steep the yield curve is.
Wow.
Okay. So now as it recovers, you'll see it go through this cyclical bull market right here.
Okay, still pretty steep.
Still pretty steep.
Ooh.
We're in 2003. This is where the stock market actually really starts taking off. Had a nice 5-year run.
Yeah.
Yield curve is still pretty steep.
Yeah.
Going up, and watch as we get closer to 2006.
Okay.
So now we're at 2004. Still a normal steep yield curve.
Yeah. Okay. Yep.
2005.
Ooh.
Now it's starting to flatten.
Yeah, it is.
We're at 2005 still. Going into 2006.
Here we go.
Still normal. Now it's inverted.
Yeah. Wow.
All right.
Look at that.
So the first time it inverted was February of 2006. Look how far before the crash and before the financial issues that happened.
Yeah, I remember talking about the inversion. Yep.
Right. So that's a warning right there. Now it actually, I think, starts to flatten and steepen a little bit before it actually inverts again.
Let's see.
All right. So now it's flat. Now it's flat. And it inverts again right there.
Yeah.
November 2006.
Yeah.
So if you didn't get the first warning, here's the second warning. Now, during this period, the market kept going up.
Yeah.
So everybody in the market was like, yeah, let's just ignore the yield curve.
Yeah, it's wrong.
It has to be wrong. This time it's different.
This time it's different.
Right.
So dangerous.
All right. So we'll animate again. Actually, okay, it's inverted. Let me let it go a little bit longer. It's flat. Now it's normal. Now we're at the top, and this is where it starts crashing. So as the market now, the financial crisis starts kicking in right here.
I remember it very vividly.
And now you can see what's happening with the yield curve. It starts to steepen again because the Fed is lowering interest rates.
Yeah, they are. Wow.
Right. So now as we go towards the bottom, which was in 2009, you can see how much steeper the yield curve is.
Look at that.
So now we're all the way down here at the bottom right there. And now you've got a steep yield curve, but look at where interest rates are way down here.
Look at that. That's amazing.
Now I'm not going to go all the way through to the end because it actually inverts briefly just before the COVID crash, but it was very brief.
Yeah, 18. I remember.
But it's been pretty much normal from this 2009 period all the way to where we are right now.
Yeah. So you're so the yield curve, because I've been watching 2s and 10s. They are getting
This
pretty
is
close.
twos and tens right here.
Oh, there you go.
This is a 20-year chart, twos and tens. You can see this is the 2008 financial crisis. You can see the inversion. Here was a brief inversion just before the COVID crash.
And that's where the red gets above the black line.
Right.
Yeah,
Where the red is above the black. The
yeah,
red is the 2-year. Red's the 2-year. The black line's the 30-year.
How close are we right now?
So right now, I think I had one for right now, right here. So here's the current view. And this is actually the 10-year and the 2-year.
Yeah, that's what I watched. 10
rather than the 30. So right now we are getting close, and you can see the 2-year is steepening much faster than the 10-year.
Yeah.
But we're not there yet. Now, what happened last week was the 10-year spiked way up when the Ukraine invasion started.
The 10-year
normally,
the 10-year spiked, but yield fell. Yep.
But yields fell. But normally when the 10-year spikes higher, that's bad for growth stocks.
Oh, for sure.
So the market fell, but then the 10-year came down right away.
It did. I saw it. And I've been telling people you got a little window to get that 30-year money. Rates went down.
Yep, it's right in here.
Absolutely.
So it's not inverted yet, but you can see the 2-year is climbing much faster than the 10-year.
Yeah,
which will eventually lead to an inversion.
I think we're headed there as well. I really do.
Now remember, the inversion is usually 6 to 9 months, and as we saw in 2008, it was as much as 2 years. The first inversion, was as much as 2 years before the recession happened.
Yeah.
Right. So it's an early warning. Think of it as a canary in the coal mine.
For sure.
When that inverts, doesn't mean we're done. Doesn't mean the crash is coming. Doesn't mean the recession is coming yet. But it is out there.
For sure.
So you got to be careful.
Very cool.
All right. So let's talk about, first of all, I'll give a little plug to this guy, Tom Bowley. He's really, really good. If you go to Stock Charts, you can get his blogs that he posts every week. It's free. There are other folks out there on Stock Charts that post things like this.
Okay.
But his is really good. This is last week's sector list. So as we had that big run up at the end of the week, he likes to look at what the internals of the market are doing, and that's really important. Something I like to look at as well. Okay. That's great. We had a great run up, but who was leading the run up? Yeah. Well, it turns out defensive sectors were leading the rally.
True. Yeah, healthcare, real estate, utilities. Yeah, I'd say defensive.
Right. So it's great that we had a rally, but it was defensive sectors that were leading it, which is not sustainable. Now, what does not sustainable mean? Where are we going? So this is a chart I've posted before. This is a reversion to the mean. These shaded areas are the average true range. So the average range, this is the S&P, the average range that the S&P trades in under normal conditions. The dark shaded area in the middle is a normal 1-day average range. Got it. The next area to the outside is 2 days average range, and the lighter one is 3 days. It very rarely gets that far, and when it does, it doesn't stay there for very long, to 3 ATR. You can see where it went here on Thursday. This is Thursday's.
That was a wild day.
It opened way down here and continued to sell off just above 4,100, 4,114. Yeah. And then the rest of the day, it rallied back big time.
Something I wanted to ask you, knowing that we were going to talk today. Tuesday felt like the machines took over.
Oh, yeah.
It's what it felt like to me, right? The market got low. It was probably second, third deviation, at which point the market was flashing oversold. And my guess is the machines or algos kicked in, because it was wild to see that reversion in the afternoon.
So this blue one here is Thursday.
Yeah.
This red one just before it is Wednesday. If you remember what I've been saying for quite a while now, 4,300 is the line in the sand. Okay. 4,300, you can see it bounced back here on 43, it bounced here on 43. I've been saying that 4,300, if we go below it, then the machines are going to kick off. Okay. And you can see here on Wednesday, we went below it and had a huge sell-off. Very fast, rapid sell-off below 4,300.
Mhm.
And then on Thursday, the machines were still kicking in when at the open,
Yeah,
open way down here.
gap lower.
But actually the machines were still cranking it out during after hours when the market wasn't even open.
Yeah.
Right. It opened way down here, kept going down, and then the machines kicked in again because we're at 3 ATR. The machines are saying, hey, this is the point where you typically reverse.
Yeah.
So the machines saw that and said, okay, now it's time to buy. So all the machines took over and they started buying.
So that's what I was thinking, but is that a fair? So it sounds like maybe that's what happened. Okay, cool.
Yeah, I mean, it's a combination of things.
Of
course. A lot of the big institutions and hedge funds, they know this too. The reason that technical analysis works is because everybody else is doing the same thing.
Exactly. They saw
why it works.
deviations and they
everyone else sees 4,300. Everyone else sees this head and shoulders pattern, which I'll show you here in a second. You know, they're programming their machines to recognize it. All the hedge funds recognize it. So they're like, you know, 4,300, if it doesn't hold, we're going to very quickly go down to 41. So I'm putting my stop in right below 43. So they're putting stops in. I think I said this in last week's newsletter. You know, the stops are probably at 42.50.
Yeah, you did.
So on Wednesday, when we dropped through 43 and hit 42.50, it very quickly sold off because all of those stops were taken out. Even regular people may be putting stops in right there.
For sure.
But the machines are seeing it as well. So the machines took over and it just kept selling off.
Okay.
Now on Thursday, we got the reverse. So where is the reversion to the mean? Now, the middle of this dark gray one right here, this dotted line, is right in here. You can see right here, it broke through it and came back and broke through it slightly and came back. And I actually drew a line across the tops, which puts it right here at about 44.50. And that's what I said in my newsletter. 44.50, 44.60, the 200-day moving average, which is this dotted gray line. That's the other one institutions and the algorithms look at. So I think we're going to continue next week up to this area.
Okay.
And then you have to watch it. Now, will it sell off? I don't know. Will it break through it and continue higher and we get to all-time highs in the market? Yeah, it could. That could happen. Anything can happen in the market.
Got it.
I don't think it's going to happen. I think we still have more work to do to the downside.
Right.
So, but this is the area to watch next week. And we could get there and, you know, by Tuesday, we could get there.
Yeah. And again, next week, like we talked about in episode 1, it's got some larger geopolitical and economic things that go long beyond just technical trading. There are really, next week's going to be messy.
Yeah. And I'll just make a comment about that because I've heard before, I mean, even when I was talking about, you know, 4,300 and it broke through 4,300 and I heard people, you know, sent me notes saying, yeah, well, it had nothing to do with technicals. It's because Russia invaded. I said, well, that's true, but it could have been anything. I mean, I don't really care what the reason is.
Yeah.
If you look out the window and look across the street and you see a fire in your neighbor's kitchen,
yep,
you're not going to say, gee, I wonder why that fire is burning.
Exactly.
Let me make sure I know why it's burning before I call the fire department. No, you're just going to call the fire department.
No, you're right. Yeah.
So technicals always have reasons behind them, but the price always tells you what's going on.
Of course.
The price tells us. This is a closer in view of reversion to the mean. This one here is the growth stocks versus value stocks. So in a healthy market, you want to see growth outperforming value. Right now, ever since last November, this is when the big institutions, actually all the way through here, big institutions started transitioning out of growth and into value.
Yeah.
And that's why you see this line going down. Now, this is starting to move back up. Some of these things are starting to move back up. So we may actually get a bounce, like I've said before. We may get a bounce back to the reversion to the mean.
Cool.
This is the head and shoulders that I talked about. Everybody was talking about this when we made this right shoulder. This is when we came back up to 4,600 after hitting 43 right here.
I remember. Yeah.
Right. So it made a left shoulder over here. It made a new high, which is the head, came back down to the neckline, which is 4,300, very critical area, moved back up to 46, made a right shoulder and started down again. So this is again what all the algorithms and all the hedge funds are looking at. If it breaks through 43, then it breaks the neckline And the target for this is down here in the 37 to 3,800 area.
Woo.
That's why I say the market still has more work to do.
Right.
Now, could it continue? Could it break through this line, this downward sloping line, and continue up and get to new highs? Yeah, absolutely it could. The market can do anything.
Mm.
You know, let's say Putin says, you know what, I think I made a mistake.
Exactly.
I'm going to give Ukraine back. And in fact, I'm going to resign and I'm going to usher in a new democratic government.
Yeah.
And let the people decide who to vote for.
Yeah.
Yeah, we could be at new highs immediately.
Yeah, of course. Could.
But I don't think we're going to.
Yeah. I understand.
And one other thing that was really interesting last week. So this is a 60-minute chart over, going back 45 days.
Okay.
And this has the VIX down here at the bottom. So the VIX is the volatility index or the fear index. When the VIX gets up over 30, and especially when it gets above 35, that's really a lot of fear in the market. You can see back here in January, when we hit the January lows, the market sold off and the VIX went up here and hit around 36, 37. And then we had a nice rally.
Yep.
We went back up to 46, created that head that I talked about before. Actually, no, this is the right shoulder that I talked about before. The VIX started coming down as we had that rally, came back down to 20. 20 is around the normal area.
Okay.
So it came down and went back up again. The VIX came down to 20, and then the VIX started moving up as the market started coming down. On Thursday, when Thursday sold off, that big, huge sell-off, you can see the gap right there at the open, how it gapped down and kept on selling. Remember, this is a 60-minute chart, so this is the whole day on Friday to the right of this green line. That's all day on Friday.
Interesting.
Actually on Thursday and Friday, both. So there's 2 days here.
Okay.
So this green line is the 24th, and then Friday was the 25th.
Got it.
So it went down, and the VIX went back up here and hit this same area, 36. And as soon as it did, the market started buying again.
Yeah.
Again, this is what the algorithms look for.
Yeah, this is just another sign that the machines sometimes jump in when factors happen. They're totally non-emotional traders.
They're non-emotional, and it hopefully helps everyone understand why the machines can do this.
Absolutely.
Because it's just math. That's all it is.
Just
the math. The machines know what the VIX levels are. It's just math. It says when it gets above 36, start buying.
Yeah, that's awesome.
And that's what happened. And then the last one, I talked about this already. So this is the VIX right now. This is a chart that I use whenever it turns red right here.
Okay.
This is time to use caution. The market's going down. You can see it happen right here. And then we started, having some rallies, and then it hit red again right here at this peak. And it's starting to come back down again.
Interesting.
So, and you can see this is the S&P down here starting to come back up again. So this is why I think we may have a rally next week, early in the week. And then we'll see what happens.
Right.
This is what I call my bottom finder. And everywhere where you see these vertical blue lines, this is where the bottom was put in previously.
Interesting.
And we put this in on Thursday again. So again, I think we're going to rally unless something really dramatic happens. And what we were talking about before about Russia and the consumer, and if they have a run on the banks, I mean, that might do it.
Yeah.
But what this is telling me is, while we might have that run on the banks, I think the market is going to rally, and I don't think that run on the bank is going to happen until Wednesday.
Okay. Yeah, I think as we've said many times, we don't know what's going to happen. Some of the things I talk about are more wishful thinking, certainly. But I do think consumers are predictable. And it certainly feels like we are right for consumers, again, Russian citizens, to not be happy. The world economy is turning. They certainly are feeling like pariahs, if you will, right? Soccer games are canceled, World Cup, that. It's going to get uncomfortable. And I really do think, again, we'll know very shortly. I think a bank run starts in the next 36 hours. And I think they're going to shut the banks, and that's going to be another sign that time to be nervous. So
we'll see what happens. One last thing, because last week I set up this portfolio on ARC.
Oh yeah, how they doing? Oh, they're up 4%. Good for them.
almost 5%.
Woohoo! Kathy Wood up 5%.
And I sorted them by ROI. So DraftKings was number one, the Square, Roku, and UiPath, Ginkgo, and Stratasys, which is a 3D company, were last, bottom.
Gotcha.
But hey, they're coming back.
Very good. Kathy Wood, you made 5% last week. Congratulations.
We'll look at this every week just out of curiosity, see how she's doing.
Oh, I love it. I think this is so awesome. So congrats for those that bought into Kathy Wood's fund last week. You made 5%, which is not that bad.
So in the next session for, let me put my newsletter back up.
Yes, please.
For folks. If I do this every week, if anybody wants to subscribe, it's free. breakpointtrading@gmail.com.
Yeah, if you watch my channel or listen to my podcast, do me a favor, send a note to breakpointtrading@gmail.com. Get on the newsletter, then it's something else we can have in common. Again, doing the work is something I talk about. Dan, thank you very much.
In the next session, I'm going to talk about something I put in the newsletter about a strategy that you can use for short-term trading.
Very cool.
And I'll explain the strategy and show you how I use it.
And I'm going to ask him also to look at 2 stocks that I might be buying just to see what's going on with the charts. Thanks, bud.
You bet.